Hello and welcome along to another Property Live. Thank you so much for joining us here on your Tuesday night. Now, we're going to have a lot of fun this evening talking about how to go from 2 to 5 investment properties and when you are potentially going to be able to do that. We're going to have a lot of fun. Now, one thing I was a bit nervous about before we hit record is I said to Andrew, should we really be drinking red wine while we're presenting property investment information, talking about very important financial information? To which he said, Ed, you're not the only one drinking. Everybody else is at home as well. Now, I usually like to do a bit of a test. I ask you what colour shirt I'm wearing as a sound test.
Adam already answered.
Today I wanted to know, though, not what jacket Andrew and I are wearing. Instead, I want to know, what are you drinking at home? Let us know. Let us know down in the chat so we can make sure that everything's working. So James is drinking vodka. Melissa is drinking tea.
Root beer.
Oh, we've got some H2O and some Oyster Bay, some Chardonnay, some Yorkshire tea and some Pepsi. Okay, we're all having a good time. We've got our drink of choice. We're going to rip straight into this because we've got a lot to cover throughout this evening. And we are going to start right now. So one of the things that's really interesting about property investing is if we think back to when some people started investing back in 1994, investing was relatively easy. Now, it was never easy, but it was easier today. And this is one of my favorite Olympic memes at the moment. You know, thinking about, it is just that much harder to invest in 2024. Now, I often look to some people who are quite inspiring to me. People like Liz Harris, who's from Christchurch and owns 122 investment properties the last time she publicly talked about it in Informed Investor magazine. I think that's awesome. Liz Harris from Christchurch is actually Australasia's largest female property investor. I think about somebody who I consider a friend now, Pauline Bicel from Palmerston North. She's got 13 investment properties, and I find that really inspiring. Or my good friend next to me, Andrew Nicol, who currently owns 40. But as somebody who came to property investment a little bit later, and I suspect that I'm among friends here, maybe you're on the same page as well, maybe you're looking at, well, how many properties can I buy? How big of a portfolio can I grow? And how do I go from 2 to 5 properties? And there's a whole heap of numbers that you're thinking about, thinking, God, this is really difficult. And one of the things that has made this really difficult is another good friend of ours, Adrian Orr, has been coming out writing a number of rules that make it much more difficult for people like you and I to invest in property. We're going to talk about some of those today. The LVR restrictions, the debt-to-income ratios, and a couple of other rules as well that just make it a little bit harder to invest than it used to be. And I know that one of the big things that hold people back is not just getting the knowledge, but also getting the money to invest. So over the last 5 years, I've been surveying you guys, and over 13,000 people have taken this poll about what is the number one thing holding you back from taking the next step and growing your portfolio. And about 28% of you guys tell me it's getting the right knowledge. Another 28% say it's getting the bank finance. So those are the two things we're going to really focus on today when we're thinking about how do we go from owning 2 to potentially 5 investment properties. And of course, one of the things that is difficult is running all of those numbers. So one of the things we're going to talk about is, how do you run those numbers? And it's always been difficult in the past. So a couple of months ago, I hired somebody who was in the top 20 in the world at Microsoft Excel to build me a very special spreadsheet. And by the way, you're going to get a copy of this for free just by sticking around to the end of this webinar. And I said to them, I really want to forecast. I want to create a model that forecasts how many properties the average New Zealander can actually purchase over the next, let's call it 15 years. And as you'll see tonight, the exact number of properties you can buy and how quickly you can grow that property portfolio, it really depends on your own numbers. And so that's the whole reason we created this spreadsheet. We've given it away once before on one of our webinars, and I've kept it under lock and key. This is going to be the last time I give it away for maybe some reasons that I'll go through a little bit later on. So we're going to talk about that as well. And as I said, you are going to get that spreadsheet for free, but only if you stick around to the end. Now, Andrew, before we get into it, some people will be sitting here being like, look, who are these guys? Because there are like over 2,000 people registered for this webinar.
Yeah, I have to say, it's pretty exciting this close to Christmas that we can still get a crowd of such a large number. So also one of the big things is we want to build a community, so make sure you're chatting amongst yourself. But just to kind of give you a little bit of background about us, just in case you're thinking, who are these guys, and you're new to the Opus group. So firstly, we've got the country's #1 business podcast, the Property Academy podcast. And for anyone that's new, this is a daily podcast, comes out every morning at 4 a.m. Some ungodly
Still
hour.
4 a.m., yes.
4 a.m., 15-minute podcast about anything to do with property and wealth creation and all those fun things. We've had over 9.4 million downloads now, which we're pretty excited to almost hit the 10 million mark next year. We're over and above what we've done in terms of podcasts, because that's been going for 5 years. Well, we've done over 50 webinars. We started those in COVID lockdown, did them every week until we got out of lockdown and had other things to do, and then now we've done them every month since. So on our website, you can go back and see over 50 webinars about all things property related. And we've got 17 financial advisors within the Opus group. And our book, Wealth Plan, is currently in bookstores. It's a guide to building wealth through property investment. Great read over the Christmas break if you at a loss. Ed is an economist here at Opus Partners. He's a property investor and he writes regularly for the New Zealand Herald. I write for Stuff. I'm the managing director and financial advisor at Opus Partners, and I am also a property investor, as Ed mentioned before. So what you're going to get tonight, so the webinar is free. You're going to get a recording of that tomorrow for free. The Q&A at the end is some of the most valuable part of the webinar. And the reason for that is because we don't know what you want to know until you tell us what you want to know. And so we'll get a bunch of other topics later on at the end.
And speaking of that, we're coming to your favourite topic of the entire webinar.
Oh, this is the bane of my life. Please, as my Christmas present, do me one thing. Put your chat in the chat section and put the questions in the Q&A section. The reason for that is because Ed and I will do our best to answer as many of the questions at the end as we can, but if they're in the chat, they get kind of lost amongst the conversation, and so we miss them, and there's some great conversations that go on there. And the other thing is, make sure you switch your comments to everyone, not hosts and panelists, otherwise only we will see it. If you make it for everyone, then everyone's going to be able to join in on the dialogue, and I think that's really important. Oh, and by the way, we've got two of our good-looking staff in the group tonight, Neffy and Dennis. They're financial advisors with Opus Partners. They're property partners. They help with investors building their property investment portfolio and building their wealth. So they're going to be answering questions as we go as well.
So there are going to be 3 things we go through, but just before I tell you about that, I love to do a bit of a poll and make this quite interactive. So Producer Dave is about to put a poll across your screen, and we're going to ask you guys, how many properties do you currently own, including your own home? Is it none yet? Is it 1 property? Is it 2 to 3 properties? Or is it 4+ properties? Make sure you click on that little pop-up so we can see where are you guys at right now. And as we say at every single webinar, we can see this live. So I can see already 300 people have already responded to this poll, and really interesting results.
Yeah, really interesting.
We're going to close that off in 5, 4, 3, 2, 1. I'm going to end that and share that with you guys. So I can see that only a small proportion of you guys are first home buyers. You don't own a house yet, but it's great that you guys are here. Quite a number of you, about a quarter of you, own 1 property, whether it's your first investment property or whether it is your own home. And quite a number of you, about 50%, own 2 to 3 properties. So that might be your own home plus a rental. It might be your own home plus 2 rental properties. And a couple of you guys, about 62 who answered that poll, have 4 or more properties. I think that's awesome, just to get a sense of where are we at. And it sounds like we're all in the right room. So what are we going to talk about? We're going to go through how the banks decide to give you money, some different ways to get the bank to say yes, and then we're going to cover off how many properties you can actually buy, and we're going to give you a live case study and scenario. So let's start with how the banks decide to give you money. And it's really important to understand there are basically 3 mortgage rules now that we are here in 2024, heading into 2025. And yes, Adrian wrote some of these. The first one is really simple. Do you have enough deposit? The second one is, can you afford the mortgage? And 3 is, don't have too much debt, or how much debt do you actually have? Now, these correspond with the 3 rules that you might have heard of. So, have enough deposit. What's that? That's what we call the LVR test. So, sometimes you'll hear about the LVR restrictions and things like that. That's basically, do you have enough deposit? Next up, you've got, can you afford the mortgage? And in mortgage broker speak, there's probably some mortgage brokers here tonight. That's basically the servicing test, or what we call UMI, uncommitted monthly income. We'll talk a little bit more about that. And then also, don't have too much debt. That's what you call the DTI test. So I've kind of got it in mortgage broker speak, and then also everyday speak, what most of us will understand. And it's really important to really catch on to the fact that the banks actually run these tests. So the banks make their decisions by having spreadsheets that mortgage brokers will run your numbers through to basically get a yes or a no. Now, it's quite funny, Andrew, because a couple of years ago, I think it was in 2021.
I know exactly when it was because I was away.
And
you got us in trouble.
I did get you in trouble, or I got myself in trouble, because we did one of these webinars. And what happened was I actually shared a couple of the bank's actual spreadsheets. So I pulled up one of the bank's spreadsheets and walked everybody through it. And it was a great webinar and everybody loved it. And the next day we went into lockdown. And the day after that, I got a call from some of the banks who were not very happy that I'd shared their spreadsheets, because that was actually on me. I was very naughty. I later found out I shouldn't have done that. So what do we do instead? We create our own. And so I'm going to take you through our own spreadsheet that basically does the same thing. So what this will do, and we'll show you this, but it effectively runs those 3 tests that the banks run. UMI, can you afford the mortgage? DTI, don't have too much debt. How much debt do you have compared to your income? And LVR, do you have enough deposit? And what you can see in that highlighted section is the amount you can borrow under these 3 tests might be different. So this person has got a really good LVR position. They've got lots of deposit available, so they can borrow a lot of money. Under the DTI test, i.e. don't have too much debt, they can actually still borrow $1.4 million. It is a lot of money, but it's the UMI. It's whether they can afford the mortgage or not, and we'll talk a little bit more about that in a second. That is the limiting factor. That is the lowest one. So when the banks run these 3 tests, they'll then say, well, what is the lowest number that you can borrow across these 3 tests? And that is what you're able to borrow. So this is really important to understand, because the first thing you've got to do when we're thinking about borrowing more money, growing your portfolio, is what is, or which of these 3 tests is the thing that is actually holding you back. Now, I do want to talk a little bit about UMI specifically, uncommitted monthly income, because this is the thing that's a little bit harder to understand. LVR restrictions, most of us, if we've got a couple of properties, understand the deposit side. Debt to income ratios, 7 times your income for investors. Again, a little bit easier to understand. It's the UMI that's really difficult. And so, Andrew, I want you to talk to us about how this works.
Okay, so the way this works is the bank's going to look at your income, your equity and your income. Now, the one big thing here is you've got to remember that not all equity and not all income is bank recognised. And what do I mean by that? Well, if you get bonuses and they're pretty irregular, the bank might not consider that your income. If you get commission, they might scale that back. If you pay yourself out of a business, they might go on the averages. So not all income is created equal. So let's talk about what the bank does to make the decision. So they look at what your income is. So that's you and your partners. Then they also look at the rental income that you've got coming in, both now and also once you've bought an investment property. And they discount that by 25%. And the reason they do that is because they're accounting for costs like rates and insurance and maintenance and all those kind of things. So whatever your rent is, let's say it's $40,000 a year, they're going to take 25% off that, i.e. $10,000, and they're going to look at $30,000 as your servicing income. And then they take your boarder income if you've got boarders at home, and different banks have different thresholds for the maximum you can charge a boarder, so you can't charge someone $1,000 a week and have that considered as boarder income. They take your maximum that they'll allow, and then they'll discount that by 50%. Then what they're going to do is look at what your expenses are. And the way your expenses work is they look at what your personal or living costs are. And so they work out, okay, 2 adults, 2 kids, 2 cars, they should cost $2,500 a month. So therefore they apply that or whatever you've stated as your minimum. Then they look at all of your existing debt that you've got. And then they add on any new mortgages as if you're paying those as well. Now, one of the key things to consider when you're looking at your existing debt, or they're going to consider your existing debt plus new mortgages, they work on a principal and interest mortgage based on the current term or a 30-year term. So your existing mortgages might be 10 years to pay off your mortgage. They're going to work at P&I on 10 years, and they use an interest rate at whatever the servicing test rate is. So at the moment, it's around 7.5%. So although you jump online and you might see a 5.5% interest rate for 2 years, even though you might select that, the bank's going to add on an extra 2% in that case because they want to know that you can tolerate higher interest rates than you're going to pay today. And they put this all together, and the way it works is they go income minus your expenses equals the surplus. And that's called your uncommitted monthly income. That's the amount of money that you can put towards either future debt, or they want to know that, yes, you've got a minimum threshold. You're not going to spend more than you earn.
And the interesting thing about that is the calculations are hard, but the actual logic behind it is quite simple. It's just once we give you this mortgage, if interest rates were to go up and a few things were to happen, could you still afford it? Would we effectively bankrupt you where your income isn't covering all of your expenses? And the important thing to recognise is that's really responsible that the banks do that. And in fact, if they didn't do that, New Zealand would be in a really difficult situation because you'd have even more people who really just can't afford their mortgages. I understand interest rates are high and it's difficult at the moment, but it'd be even worse if the banks didn't do this. Okay, so what we've then got to think is, well, if that's how the banks decide to give you money, what are some of the ways to get the bank to say yes if they're currently not saying yes? Andrew, what are some of the strategies?
Okay, so let's talk about number one, which is to increase your income. You can either increase your income or you can decrease your expenses. So in terms of your income, you can either get that up or decrease your expenses. And your expenses are your living expenses, your debt servicing, i.e. your debts, or your new mortgages. Now, let's talk about some of the ways that people do this all the time. So personal income to begin with. One of the things that we see very regularly is that there's a couple, someone's on maternity or paternity leave at the moment, and they might be returning to work next year. Now, that's going to bring in more income, and you can, if you've got an arrangement with your employer, you can get a letter from your employer to say, yes, Jack's going to be back at work part-time next year, and he's going to earn $30,000 a year. That can then be used as bank recognised income. Cool. Let's give you another example. So boarder income. So if you don't have a boarder or a flatmate right now, maybe you can get one. Now, if you've just had a kid and you've just returned to work and you've now got 2 kids at home, one infant, and you've only got 3 bedrooms, the bank might be a bit wary about you getting a boarder. So just think about this in a practical way as well. You want to be considered, okay, yep, if I'm double income, no kids at the moment, boarders are a great way to pay down your mortgage faster and bring up your servicing. In fact, I just got off a Zoom meeting with a couple who have a couple and an individual at their house, bringing in a decent amount of boarder income every week. I think it's a great way to pay off your mortgage faster, but also to bring up your servicing UMI. Then, of course, you need to think about your debt servicing and financial payments. You might be thinking, well, I can't do much about my mortgage. I'm paying it off as quickly as I can, and I want to borrow $600,000 for my new investment property, and I need all of that to buy a property. So what can I do here? Well, a lot of time, people, if they've got existing rental properties, they might have the rent as a lower amount than what the market is, particularly if they're managing it themselves. So one thing that I often recommend that investors do is talk to their property manager, and if you're not using one, you probably want to talk to one about whether or not what you're charging is a fair market rate. And if you're under renting your properties, it could be affecting your ability to buy the next investment property, so you really want to keep on top of that.
And in fact, one of the big things that we see and one of the big things we talk about in our book, Wealth Plan, is specifically how you restructure your debts so that you are much more attractive to the bank. And in fact, that's what I'm going to talk about now. One of my favorite strategies that we talk about in the book is called the commitment issue strategy.
You would know about this, wouldn't you?
I know.
7 years you're with Kelly.
Mate, you can't say that.
Sorry.
I told you not to say it, eh? It's like Voldemort.
Smelly. Oh, no, sorry.
That's worse.
Sorry, Trelly.
Okay. Look, I'm going.
Harris, I'm sorry.
I'm going all red now. I can't believe you said that. Oh, okay. I am going red now, Andrew. So, the commitment issue strategy is all about changing your financial situation so you are able to borrow more. So this is a real screenshot from one of the bank's spreadsheets that my compliance officer said that we could share. And one thing that's really interesting is even if your credit card is fully paid off, most banks will still look at the limit. So let's say you've got a $30,000 credit card limit. They might say, well, it doesn't matter that you haven't spent $1 off it. We're still going to assess your financial situation like you are paying $900 a week. In fact, some banks are higher than this. Might be $1,200 a month, not week. $900 to $1,200 a month paying on that credit card. And the reason they will do that is because once they approve your mortgage, if that credit card is approved, you could go and max it out at $30,000 and then pay the minimum amounts. So the main takeaway here is you can have no credit card debt, but be assessed, or the bank will look at it as if you have maxed that out because you could once you go ahead and take out that loan from the bank. And there are a couple of other ones that we talk a lot about within the commitment issue strategy. You can do things like cancelling your credit card. Again, with that $30,000 limit, if you just cancelled that credit card, the bank would look at you as if you've got an extra $900 a month of after-tax income. That's huge. The other thing you could do are things like extending your mortgage terms, and I'll give you an example of that in a second. You can potentially consider stopping voluntary KiwiSaver repayments. You'll want to get some investment advice about that, but that's another strategy some people use. Consolidating debt and sometimes even paying off the student loan early. This can have quite a large difference. In fact, in the example I'm about to show you, you could adapt your financial situation, not change any of your debt in terms of not take out more debt, not pay off any more debt, but you could restructure it and get an extra $2,800 a month in the bank's eyes. Let's talk about how. So let's say that you do have that $30K credit card limit. You haven't spent $1 on it. Well, the bank is assessing you as if you're paying $900 a month towards that. One option, cancelling that limit, cancelling that credit card, or reducing it. That could potentially get you an extra $900 a month in the bank's eyes. And if you've got more income in the bank's eyes, or you've got lower expenses in the bank's eyes, then yeah, you're probably able to borrow more. Let's say that you've got a $16,000 hire purchase. You've gone out, you've gone to Harvey Norman, and you've purchased a really nice settee set. And the bank, you might be paying $750 a month towards that. And it might even be interest-free. Well, one option is you could consolidate that loan into your mortgage. I'll tell you what that means in a second. And potentially get an extra $674 a month, again, in the bank's eyes. Let's say your KiwiSaver is at 8%. The bank's saying, hey, at the moment you're putting away $667 a month into your KiwiSaver. Well, if you reduced that down to 3%, then you'd have more money hitting your bank account. And in the bank's eyes, again, more money hitting the bank account. You've just got a pay rise. Now, you could still be investing that $417 a month. But because that money is hitting your bank account, that is now a discretionary expense. In the bank's eyes, you could stop that if you wanted to. And because of that, you've got lower expenses. Let's say you had a $500,000 mortgage that you're paying off over 20 years. Now, if you increase your loan term to 30 years and said, okay, Mr. Bank, I'm now going to pay this off over 30 years, you would have additional income. Now, again, you could decide to still pay off your mortgage quickly, but it's about decreasing the minimum repayments that you are committed to. That's why it's called the commitment issue strategy. We reduce the minimum amount you're committed to, which means that you've got additional money to service more lending. And one last thing, what if you had a 20K car payment, you consolidated that into the mortgage, you could potentially get an extra $169 of uncommitted monthly income.
It's a lot of money, isn't it?
That is huge. Now, of course, we've made the numbers look large, and this would be a larger scenario, but there are lots of opportunities that you have that we talk about in the book to that no that the bank's currently giving you into a yes. Now, let me just talk about what consolidating your debt means. What does that actually mean? So let's say you've got a $20,000 car loan. It's 12% interest, paid off over 7 years. That's costing you $353 a month right now. And let's say you've got a $400,000 mortgage, 6% interest, 30 years. Now, if you were to consolidate that car loan into your mortgage, you would get a mortgage top up, take out an extra 20 grand, and use that to pay off the car loan. That does two things. First of all, it gets you a lower interest rate in this scenario, and it also stretches those payments out over 30 years in the bank's eyes. Now, let me be very clear, because some of you will be saying, well, wait a second, Ed. If I've currently got a car loan that's been paid off over 7 years, I don't want to then put that into my mortgage and pay it off over 30 years, because I am going to be paying way more interest if I pay it off over that time. Again, we're not saying that that's what you do in practice, but you're decreasing your minimum expenses, and you can still put that money towards that loan, pay it off over the same time frame, but it's about freeing up cash in the bank's eyes, in the bank's scenarios. That's a very important distinction. And so the other thing I'd say as well is, even if you were paying off hire purchase, yes, a T-set, over 3 years or whatever, if you consolidate it into your mortgage, it might be that it's not forever either, that you start paying a bit of interest.
Yeah, you might do that for the next couple of years while interest rates are high, and then as they come down, you might continue payments at the same rate, pay off your mortgage faster now because you've got more disposable income.
So commitment issue strategy, I really rate it. We're going to give you a good example of that a little later on. Now, Andrew, there is another strategy we talk about in the book.
So we talk about the... Go on, dance.
No, they probably can't hear that because it's coming out of my laptop. But it's one of the greatest songs of all time, Burn Baby Burn.
The Earn Baby Earn strategy. And the way this works is we want to get your income up. And there's many ways that you can do that, because remember, it's not about what you earn, it's about what you can prove or what the bank will consider your income. So I'll give you an example. What you could do is you could decide, hey, I'm doing 37 and a half hours a week. I'm not working as many hours as I possibly could. Again, I don't have any kids at the moment. Maybe I'll just increase that and do some overtime. Maybe another thing, you might go and negotiate a higher rate for your salary, which we've had a lot of clients do that. So we've worked with people who they're so close to being able to get a mortgage to buy an investment property. They've gone and figured out, okay, well, what do I need to be able to make this work? They've gone to their bank. They've said, their employer, I want a $7,000 pay rise. They end up getting that pay rise. And the great part about that is, yes, you get the mortgage, but yeah, you also get another $7,000.
And then the other really interesting one I want you to talk about, restructuring your payment package.
Yeah, this is a really interesting one because it's something that people don't consider all the time, right? Imagine if you had a 100K base salary and you had 20K worth of commissions on top of that. Now, remember, with commissions or any of those extras that you get on top of your base salary, they are scaled. What I mean by that is the bank will take off a percentage because they're not guaranteed. So commission's 50%. So say you earn $20,000 a year for commission, well, that's only $10,000 that the bank is going to consider. So what you might do is negotiate that all to be part of one package. The next one is bugger the banks. This is one of my favorites because banks are really tough to get a mortgage with. Now, if you're going to one of the main banks and you're getting a no, it could well be that you can actually get a yes or a maybe from one of the non-bank lenders. Now, for any older people on this webinar, you might be thinking, oh, finance companies, they're really risky and they collapsed back in 2007. I'm not talking about a finance company like that. I'm talking about the step above the bank, so they'll take on more risk. They'll charge a little bit more money. It might be another % or another couple of %, but it gets the job done. So for a lot of investors, that might be a really good option if the bank's saying no at the moment.
It's also important to say that non-banks have been really non-competitive over the last probably year or two. Now, what I mean by that is because you're using the wrong mouse, mate. Because interest rates have been really high, you might have been paying 7%, or I think on one of my mortgages, I got up to 7.2% at one of the banks. And so paying that extra percent to go to a non-bank and paying something with an 8 in front of it, some people even a 9 in front of it, look, that just doesn't work for most of us. The fact that we've seen quite substantial drops in interest rates starts to mean that maybe the non-banks are a little bit more doable where they weren't before. And the falling interest rates do provide it makes a couple of strategies that didn't work before, it makes them a little bit more achievable. And so a lot of people think that, look, I just need to pay debt to get ahead. I just need to pay down debt. That's how I'm going to be able to get the yes to buy an investment property. And that is sometimes true. Don't get me wrong. For some people, that is absolutely what they need to do. But sometimes it's about restructuring your debt to get ahead. And it's something that we're not taught at school. And so we've got to learn it at a webinar on a Tuesday night at Property Night School, I guess we could call it. But restructuring your debt to get ahead, that's something that a lot of people should consider, and they haven't before.
Often this comes to an age and stage thing as well. When you start out and you buy your first property and you max out your borrowing ability, you probably can't do a lot on restructuring. That's when you just got to pay down debt and build up your equity. But as you get further on in life and you kind of have these little bits here, like a settee set. Who calls it a settee set, by the way?
I think probably my parents back in the 90s.
Or you've got extra credit cards because the bank keeps increasing your limit, or a higher purchase, or whatever you've got. Maybe just restructuring some of that stuff to get ahead. It's a really smart thing to do.
Now, one other strategy I really want you to talk about is the sell one to buy two, because this actually isn't about UMI. This one's really about equity, but for some people who have picked up properties over the long term, it can be quite important.
Yeah, so the thing about property investment is people kind of often don't have a handbook about what they should buy, and they end up with these niche investments. And I see this all the time working with investors day in and day out. So let's talk about some of them. So hotels or small apartments, or maybe leaseholds. Now, the pros, they're really high yielding. You'll get a really good rental income from that property. The downside is it's poor bank recognized equity, and it normally sucks up a bunch of your equity and other assets to be able to invest in those. Bare land's another great one that gets really high capital growth, but the con is it's going to suck up a whole lot of your equity because, again, the banks don't allow it as high an LVR on them, but also the income as well, because you've got debt, but you don't have any income. Bottom line is, if you get a poor return on investment based on these type of investment properties. Now, let's talk about land for a moment. I'll give you an example. Say I own a piece of land, the value is $500K, the mortgage is $550, so your equity is mortgage is $250, your equity is $250. So you might be thinking, I've got all this equity in this land, I've got half a 50% mortgage, great, I'll take that out and I'll go and buy an investment property. Now, here's the way it works with land. Value's $500. The max LVR on dirt is 50%, unless there's some criteria around that. If you're going to build on it, it's going to be for yourself. But normally speaking, if you own some land, your land banking, it's 50%. That means your bank value, the maximum that a bank will lend on that, is $250K. That's what you've got already. So if you've got that already, you don't have any ability to leverage against that property. There's no usable equity in that, so therefore you don't have any deposit for the next property, and it's sucking away your personal income and that uncommitted monthly income calculation.
And that's why some people will be like, well, hang on, I've got all this equity, 250 grand, that's a lot of equity to have in a property. How come the bank won't let me borrow anything against it? That can sometimes be the reason.
And it's the same with things like leasehold apartments or just small apartments, where again, you might have thought, or a hotel. I've seen so many people kind of a little bit older that maybe have bought these these hotel investments thinking, oh yeah, it's really good cash flow, and then they've ended up not being able to borrow as much. Or maybe it's a developer that or a development that the bank's not that happy with. Particularly in Wellington, banks take really close attention to their what's called their saturation levels. So do they have more than their market share would dictate? So for example, say BNZ has a 20% market share in a particular development, and you own a property there, it could be that you can't lend any extra against that because they're already at their max.
Okay, that's really fascinating. So how does the sell one to buy two work? Well, if you were to sell that piece of land, right, for 500K, we always assume it costs you about 5% of the property's value to sell. That would mean you'd be able to come out with 225 grand worth of cash. Now, just to take it to its absolute maximum, if you were to go and invest in new build properties, then you'd only need a 20% deposit, which means that your potential budget is now $1.13 million as opposed to what we were on before, a $500,000 asset. So that's sometimes where you can replace a $500,000 asset with over $1 million. And so that's effectively where sometimes investors will sell one, in this case a piece of land, to buy two investment properties.
So not only do you now have more assets that are going up in value, but also you've got double income.
Now, there are a couple of other strategies that we talk about in the book, but since it's Christmas, it's December, and we're all getting to the end of our tether a little bit, I want to jump into a case study. But before we get into that case study, I want to do another poll and ask you, how big do you want to grow your portfolio? Do you want to grow it to 2 to 3 properties, 4 to 5 properties, 6 to 9 properties, or maybe even 10 properties plus? Producer Dave is going to put that across your screen, and we're going to get a sense of where you guys are at right now. How big do you actually want to grow your portfolio?
Pretty ambitious people here.
Yeah, and
awesome.
And also some very, some people that are saying, I don't need that many as well. Just remember, don't put it in the chat. Answer it in the poll so we can kind of understand where everybody is at. And we've got almost 400 people answering that. I'm going to close that. Somebody said you should have the option for 100 properties. I love the ambition there. I think that's awesome that some people are like, yeah, I want to go really, really hard. We're going to close that poll off in 3, 2, 1. Close that, and we're going to share that with you guys. So 40% of people, the largest group of people are saying, look, I actually want to grow to 4 to 5 properties. I think that's a really realistic target. It's probably because that's what the webinar is about as well, how to get to 5 properties. So maybe some of you guys had it in your head. About 20% of you are saying 6 to 9 properties. And a good number, actually, just over a quarter, are saying, I want 10 properties or more. That is what I am aiming for. And 15% of you are saying 2 to 3 properties. So a really good spread there. Now, the wonderful thing is we're going to jump into a case study now, and we're going to talk about somebody who wants to grow a portfolio and talk about, well, how many properties can you actually go ahead and buy? And yes, this is when we get to pull up our spreadsheet and have a little
Why
look-see.
are we a couple again?
So what I'm going to do is I'm going to say that Ed and Andrew are a couple, right? And we're coming in. It's the end of December 2024. We want to go and buy an investment property. And I'm going to show you our setup and what our numbers look like. And then we're going to see how many properties we can buy. And then we're going to adapt it. And we are actually going to apply some of the strategies that we've talked about in this webinar to try and get the number up. So first of all, I'm going to say that Andrew earns a salary and he earns $100,000 per year. And he also earns commission of $20,000 per year. Me, I earn $80,000 in this scenario, and we're a household, right? And we're investing together. And I'm going to say we've got 2 adults, 2 kids, and 2 cars in the household. Nothing else. And on top of that, we've got 2 properties. We've got an owner-occupier, and we've got an investment property, okay? Our owner-occupier is worth $1 million with a mortgage of $600K, and our investment property is worth $800,000 and currently also has a $600K mortgage on it.
So quite a lot of debt at the moment.
Quite a lot of debt. And actually, Andrew, can you just show me your screen so I can see how big this is for people if you jump into Zoom? I always like to just monitor.
Good, that's good.
I like to monitor it because sometimes we've been too far zoomed out. Our investment property is on interest only for 3 years, and our own home, we're paying that off over 15 years. Our investment property, $500K. And let's take a look at our credit cards. Oh, Spendy Nickel. Andrew Nickel.
We've both got $30,000 limits. What are you talking about?
Well, I'm going to claim that this one's Andrew's. Andrew's credit card. He has, he's been
on it.
I've
been buying you a Christmas present.
What did you get me? Well, you clearly done it because you haven't to think about it.
Yeah.
So we're going to say 60 grand worth of credit card limits, a 10K balance, and of course we've got a settee set, $15,000, and we pay that off at $750 a month.
Is that how you spell settee?
Well, and to be honest, I don't know how you spell it.
Anyone in the chat, is that anyone there from the 1920s that knows how to spell settee?
Hey, don't be offensive to all the people from the 1920s. How do you spell settee? If nobody types it in, I'm going to... Oh, it's got 2 T's.
Ah,
it's
yeah,
got
couch. Thank you, Peter.
Good on you. Okay,
we
we're going
go.
to change
Okay,
that.
thank
See, we're doing this as a group. Yeah, there we go. It's a settee set. So let's take a look. And remember, this is how you guys are going to put your numbers in. Okay, so we're going to start up here.
So this is an interesting one.
So we are going to start by looking at our UMI, which remember is can we afford the mortgage, DTI, how much income do we have compared to our debt, and LVR. Now, Andrew, what is this telling us right now?
Okay, so LVR equity, we're fine. We can go and buy up to $1 million of property, new builds, based on the fact that we've got good equity in our properties at the moment. Now, based on DTIs, look at the length of that password. It's ridiculous.
I was just doing it so I can highlight some things.
But based on DTIs, so debt to income ratios, that taps out for us at $410,000. But the lowest of the three is uncommitted monthly income. Based on our servicing test rates and the banks calculating our income at the moment, we can't even afford the debt that we've got at the moment. We're negative $600,000. So there ain't any chance of us buying a property anytime soon based on our current situation. And in fact, if our target property price is $625,000, scroll down.
Where do you want me to scroll down
I was hoping for the first time we could buy a property.
Oh, yes, I think I do have
We've
that
moved
still.
that now.
So the first time you're able to buy a property is going to be, where are my little graphs gone?
11 years.
It's going to be 11 years before we're going to be able to buy it.
Now, this graph is showing us our borrowing ability, but also our target property price increasing every year, and that's really important. You don't want to work on just today's numbers.
Yeah, and that's because a property that's worth $625,000 today is likely to be worth more in the future. And so at the moment, this couple, Andrew and I, we own 2 properties. Look, it zoomed out, and it zoomed out so far, Andrew. Usually I berate you for not being able to use the technology.
I know. It's always quite good when you cock it up as well.
Yeah, so it looks like this couple are able to buy an investment property, but it's not going to be for 11 years, and it's going to take us from 2 to 3 properties. And so the big question is, okay, we're here to learn how do we go from 2 to 5. So how do we increase this?
And we're just conscious of the fact that all those tricks that we've told you, all the things that you can do, the methods, you won't be able to do all of them as well. So you just got to use the tools at your disposal.
Yeah. So the first thing we're going to do, I'm going to get rid of my credit card limit.
That's great, honey. You didn't need it anyway. You never used it.
I've cut up the credit card. We're not using it anymore. Andrew's credit card.
I love that people are still debating the settee.
Andrew's credit card, he's got $30,000. For now, I'm going to put that down to $10,000. I'm going to decrease the limit, but we are going to come back to that. And the other thing that I'm going to do is I'm going to look at my owner-occupier house, our owner-occupier house. We're currently paying it off over 15 years. I'm going to go to the bank and I'm going to say, can I extend that to 30 years? Now, bear in mind, we are still going to pay it down as if we're paying it off over 15 years. We're still going to be really aggressive with that mortgage. But we're going to lengthen the term to decrease our minimum repayments, and that's going to help us borrow more. So what does that do to our ability to borrow? Now, right before, I think, what were we at? We were at negative $600,000. Was that it?
Yeah, negative $600,000.
We're at negative 600. We've already improved that by cancelling one credit card, decreasing the limit, and pushing out our term that, or how fast we're paying down our own mortgage. We're able to get that up to $160,000.
Right.
Now, we're not buying a property with that yet, but let's look at the forecast. It now looks like we'd be able to go from 2 properties, our investment property and our own home, to 4 properties over the next 15 years. So it looks like we're going to be able to buy an investment property in year 4, and it looks like we're going to be able to buy an investment property in year 10. So this is good. We've already been able to buy an extra property and pull that forward. Okay, let's try another couple of things that we can do. So we talked about debt consolidation before. So one thing we could do is take that $10,000 limit and $10,000 balance, and we're going to pay that off. And the way we're going to pay that off is we're going to increase our mortgage by $10,000. So we've done a top-up loan to pay that off. Now, you can stop arguing about the settee set because we're going to do the same thing again. We're going to take that amount, $15,000. We're going to consolidate that against our mortgage. We're going to put our mortgage up to $625,000. We're going to see what that does to our portfolio. Okay, looks like we're able to buy one more property, going to buy another one in 14 years. And also increases how much we can borrow right now to $382,000. But wait, there's more. There's a couple of other things we can do.
Someone did call you the Suzanne Paul of property investment.
I would take that. Personally, I'm going to take that. Now, one strategy we didn't talk about, but we often talk about in webinars, so I thought, we've talked about it before, I won't bring it up again today, is split banking. This is where you get to cheat on your bank. And we often say, don't cheat on tests, don't cheat on your partner, don't cheat at most things, but please cheat on your bank. Use multiple of them. Because in this case, you will see that in our situation, we have bought an investment property and we purchased it new. Now, at the moment, our LVR is such that we can't borrow more against that investment property. And in fact, that investment property is sucking equity out of our main mortgage. If I move that to another bank, we're going to be able to borrow more. Now, you might have questions about that. If you do, we're going to answer that in the questions. And I'm going to do two more things. No, I'm not going to get rid of our kids, but I'm going to go, or rather, I'm going to ask Andrew's boss to go and renegotiate his package. Can we turn that $20,000 commission into a salary? Remember, at the moment, the banks will only take $10,000 of this commission. The reason behind that is because a commission's uncertain. So they say, we're only going to take half of that income. But if Andrew was able to say, look, Mr. Bossman, can I turn that into $120,000 salary? You're paying me the same, but the bank is going to let me go ahead and borrow more money, and in fact, get me up to $500,000. Could we get the yes? So what does that take us to? Remember, we were only sticking at 3 properties before. Now, we're able to get up to potentially 5 properties. So that's our own home, our current investment property, and 1, 2, 3 investment properties because of our scenario. But I feel like we're not done yet. Because remember,
what else have you got, Susan?
Because this webinar is about how to go from 2 to 5 investment properties. And we've got 2 to 5 properties now, but there's an issue here. This is 4 investment properties plus our own home, and I really want to get to 5. And what are you
going to do?
Well, one of the things you can do when you get the spreadsheet is it actually shows you your UMI, your DTI, and your LVR tests, right? And it shows you, well, how much can you borrow under these tests and what would you need to do? So this is saying I'd need to increase my income by about $15,000 in order to be able to buy an investment property today. Now, this is not doable for absolutely everyone. But if I could go to my boss and turn that into $100,000, not $1 million.
Oh, yeah, good luck with that, honey.
Yeah, thank you, dear. If I could get that up to $100,000 per year, what would that do for me? Well, that would mean that we'd now be able to borrow $764,000 from the bank, would be able to buy today, and over the long term, would be able to get to our own home plus 5 investment properties. Now, let me be very clear. It would be totally logical for some people to be like, okay, these numbers are pretty cool, but you clearly made them work for the webinar, right? You clearly made it work so that we've got a financial situation where you weren't able to borrow and now you can. Yeah, we did it that way to show you what's possible. And your scenario isn't going to be exactly like this, right? Like maybe you're in a relationship and one person, well, neither of you actually earn commission. So you don't have the ability to use some of the earn baby earn strategies. That's okay. Maybe you're not currently paying off your mortgage at 15 years. That's okay. Maybe you can't extend it. But what are the strategies that we've talked about that you can use? That is the most important thing. It's not about, hey, that strategy doesn't work for me. I can't use all of them. It's what can you do to get ahead? And again, I'm going to send that spreadsheet to you because you've stuck around. or at least if you stick around for another 10 minutes, I'll send that to you tomorrow.
Just while you're there in the spreadsheet, there's a couple of questions about the spreadsheet. I always say this. I'm not gonna answer anything that comes in the chat, but anyway, here we are. The spreadsheet's got. How's the file considering the purchase timing, yield, etc. And I'm not quite sure what that means. So can you just go through the assumptions tab?
Yeah. So a couple of things. There are a lot of assumptions in here. And in fact, what I'm going to do is I'm going to do something I don't usually do at webinars. And, good, I've already unprotected it from earlier. So what I'm going to do is I'm going to unhide the working sheet because then we can actually go through it. So what this is doing, and this is the UMI forecast. So this is looking at your numbers over a 5-year period, and it is running Ed's income, and it's running Andrew's income like most of the banks do. It's looking at monthly rental income. It is looking at, what properties have you purchased in this year? What are your expenses? What are your mortgages? And then it is using a bunch of assumptions. That's quite important to understand. Like the fact that in this case, we are saying that if you've got a bonus, we're only going to include 50% of it. If you've got commission, the bank's only going to take 50% of it. Dividends, only 50% of it in this scenario. We're also assuming that the servicing test rate is 7.5%. To be honest, earlier this year, we used to use 9% because that's what it was. Some banks are down at 7.5%. We're assuming
so you can change that over the years in the future as well?
Yeah, we did make it so you can change the servicing test rate over several years because it looked like that it was going to come down. Now that it has, I've just kept that constant at 7.5%, though it will change. We've also assumed things like, hey, you're going to go ahead and purchase, in this case, a new build investment property at $625,000. But you could go in here and say, hey, look, I'm not doing that. I'm actually doing a burst strategy. I'm going to buy a property and I'm going to renovate it. So what does that look like? You can do that right here and change it around. So there are a bunch of assumptions. What I do need to bring your attention to is the important things you need to know, which is that this spreadsheet is pretty good. It runs a lot of forecasts. It runs a lot of calculations, but there are some shortcomings. And in fact, I want to take you through some of those shortcomings right now because it's very important to me that you understand some of these things, because there are really 3 ways to figure out how many properties you can buy. Where most of us right now are, we've got no idea. We've never thought about it. We're just going to be guessing. On the other hand, the perfect way to figure it out would be to go see a fortune teller. Because they're going to be able to predict what's going to happen to interest rates. They're going to be able to predict what Adrian was going to do next. I can't do that.
We don't recommend that, by the way.
Yeah. Well, you don't. You don't recommend that. No. In fact, I did have it. I'm going off script now because it's close to Christmas. Yeah. I did think maybe next year we should do a video where we try and invest in shares.
Yeah. And we go to a savant or something.
We go to a fortune teller and get them to tell us what we should invest in. I think that'd be quite funny.
Yeah, that'll be fun.
The spreadsheet is in the middle. It's better than having no idea, but it is not perfect, right? And so there are some shortcomings, and let me tell you about what some of those big assumptions are. It assumes you do everything perfectly. It assumes that you're paying off debt. You don't go and take out more debt. You don't go and get another credit card. You don't go buy a jet ski on hire purchase, and you buy as many properties as you can when you can. It also assumes that you don't take on more debt. It assumes that your incomes don't go down, that you're not going to go on maternity leave, that you're not going to get made redundant. It assumes you don't have more children. It assumes that house prices and incomes go up by the same amount every single year, and that happens consistently. Most of these, in fact, all of these, for most of us, probably won't work out like that in real life. You might have a kid. Your income might go down. You might take on more debt. And so it's important to just remember, this is what I call a spreadsheet scenario. It is not a perfect forecast, but I still think it's pretty good. And a lot of you are saying, hey, this is actually pretty good. We really like it. So I am going to give that to you for free.
Are you going to do it tonight? Because there's lots of questions about the spreadsheet. Are you going to put it in there tonight?
I am going to give it away tomorrow when we send out the email.
Great.
And the only reason is because Holly McLaughlin, who helps us out with all of the sending of emails.
She's gone home.
No, one of her best friends is over here from Canada. And so I said, Holly, don't worry about it, Holly. Just send it out tomorrow. We'll all understand. So key takeaways. Look, building a portfolio does take time. Another person. Someone said, we cannot wait. no.
Richard Chu, you're always asking for the spreadsheet. It'll be there tomorrow.
It's Richard Chu. If it's getting...
it's not a fucking vote. Oh, it's not a vote.
You can't swear.
It's
You
not a
can't
voting
swear.
system. We're not a democracy, people.
A lot of investors... I'm here are my key takeaways.
Sorry.
A lot of it is about getting the bank to say yes. You can adapt your money life to look better to the bank, but you've still got to think about cash flow as well as we're growing. Now, I will talk a little bit more about questions in a second, but I just want to say, so many of you are new here tonight, and even after 1,916 podcasts, 50 webinars, signing up for Opus Plus and reading our book, so many people still ask me, what is it that Opus actually does?
Still.
People still ask that. And so I want to just let you know so you know what your options are to get advice about property investment. We do two main things. One, we create property investment plans for people, right? And so we have our own software. We created it ourselves called My Wealth Plan. And what we do is we figure out what your wealth gap is and how much wealth you need in order to live the life in the future you want. And the second thing we do is we find new build properties for you. And so that's an example of Kathy Faulkner working with a property investor, trying to see where they would like to go ahead and invest. And what's important to really understand is how property investment companies get paid. So what we do is investors come to us and we've got relationships with a whole heap of developers, about 97 around the country. And if we can find the right investment property for you, the right new build investment property for you, and you say, hey, look, that's a great investment. I like that property. I want to invest. That's where we earn a fee from our developers. And it's really important to understand, I bang on about this. You do not have to use Opus. We are not the only property investment company in the market. If you Google property investment companies, sure, we'll come up, but Propel is an example of a company that does similar things to us. Positive Real Estate, they're a bit similar. Property Factory, they're another one. We're not the only people in the market. And so if you do decide to use us, if that's your choice, you do really need to understand, well, why am I using you guys compared to somebody else? And one of the big things is we use more data and more modeling than anybody else. We're like spreadsheet power users to try and help you make the best decisions. The other thing we do is our property team, Opus Licensee Services, they've got properties that you can't find on Trade Me. And on top of that, we try and show you that these are good prices, good deals. I don't want to tell you that it's a good deal. I want to show you by comparing it to the market. And these days, we've introduced a new policy where we're making developers get valuations on their properties to prove that they are good deals for you guys. And on top of that, we've got all the support you need in one place. We've got a property management company, a mortgage company, and accounting company. So what I want to do, look, it's getting close to Christmas. I'm not going to chew your ear off, but I do want to offer you a portfolio planning session. That's where you'll sit down with a financial advisor like Ben here and actually create that portfolio and plan it out. Now, this doesn't cost you anything, no fee to investors because I told you how we get paid before. Now, if this is interesting to you, I'm going to put one final poll across your screen. If you click yes, we'll send you a link to book a free time tonight. If not, then you can click the bottom one and you won't get a link. We won't call you, all good. And I'll get producer Dave to put that across your screen just so that you are able to make that choice, whether you want to have a meeting, whether you don't. And what I'll just say as well is we will not be offended if you click no. One of our long-term investors, Manuel, always says to me, Ed, I feel so bad about clicking no that I don't want a meeting. It's all good. We don't mind. We don't want to waste your time. So just click whichever one's the right one for you.
Amanda has said there's no appointments available at Opus this side of Christmas. That might be the case because we have been extremely busy over the last wee while. If you email me directly, Amanda, you'll find my link on the website. I'll see if I can find something to slot you in. Or who's in the calling team?
Jade.
Jade. If you email Jade, is her email on the website?
Jade at opuspartners.co.nz.
Jade at Opus Partners and say, I'd really like to see someone this side of Christmas. We'll get you in for the portfolio planning session. You won't be having a property selection meeting. I don't expect this side of Christmas, but we can get the ball rolling. But again, if you email me directly, I'm see if I can make it work myself.
And I had another one. Somebody emailed me just before we hit record on the webinar saying, hey, look, I really want to see someone just before Christmas. I want to come and see you. We'll make that happen. Now, one thing I do want to say, again, the other option is you can actually click, or when I say click, I mean scan, that QR code that you've got right old. There. I am getting old, eh? Oh, God, I'm old. You can scan that QR code, and you can actually book in right now if you've got it there. Oh, cool. And Neffy has actually just put her link there as well if you want to book in with Neffy. Neffy's been in the here tonight. And Savi's just asked, by the way, where's your main office? We've got one in Christchurch and we've also got one up in Auckland. So scan that QR code if you
But also we do a 95% of our meetings via Zoom nowadays, post-COVID world. And I've seen people all over the world this week.
Cool. Let's just come to a couple of key things before we get to questions. Listen to the podcast. Actually, it wasn't 1888. It was episode 1916 went live this morning. Episode 1917 goes live tomorrow. Subscribe to our YouTube channel. We release 2 new videos every single week. It'll just be a little bit quieter over Christmas because I'm going on holiday. And lastly, buy the book. Wealth Plan is currently in bookstores, or you can get it at wealthplanbook.com. I'm really proud of our book. I think that it does a really good job at talking specifically about property in the current market. And in fact, there are some things that have changed since we released that book. And I've got some podcasts coming out early next year that talk about what has changed since we released that book as well, just to keep it really current. With that, we are going to
Q&A.
open it up for questions. So stick around. We've still got over 500 people here available here on the webinar live. I can't believe it in December that so many people are still here. We're grateful that you are here. We're going to go through some questions. What's tickling your fancy?
Okay, let's just start from the top. Number one question was, this is actually just it's more of a comment than a question, and I quite liked it. Daryl said, will you do a live webinar next year with a studio audience? That would be cool. We did that maybe a few years ago.
Yeah, I remember we did that in 2021, and we really liked it, actually.
Maybe we'll put that. Producer Dave's got that on his notes. He'll bring it up.
Yeah. We'll look at doing that.
We'll look at doing that. Okay, all right, there we go. Thank you for the idea. I currently own 2, Sam said, I currently own 2 rental properties. One's owner-occupied. 2 properties. One's owner-occupied, the other's a rental. We're exploring the possibility of investing in high-yield locations like Waikato. However, financing remains a challenge due to LVR constraints. Sam, the best advice I can give you is work tightly with a mortgage broker, because a spreadsheet's great, but mortgage brokers have tricks and tips that they're going to tell you based on experience and based on what the banks are seeing right now. So I would find a good mortgage broker. If you search top 10 mortgage brokers, Opus Partners, you'll find them on our website. And we don't include ourselves on the list because we try and be as unbiased as possible, but we're awesome as well. So if you want to talk to Opus Mortgages, they'll be able to help you with that.
Do you know what's funny, Andrew? We actually, I will just say, full disclosure, we actually have started putting ourselves on the list. But do you know why? I'll tell you the reason why we've started putting ourselves on the list is AI and ChatGPT often reads our website. So when you ask it property investment questions, it will actually spit out answers from our website. And what we found is people were asking for, mortgage broker recommendations.
And we weren't there.
And we weren't there, but they were using our website. So we actually have started putting ourselves on the website. But that's the reason why.
Okay, next one's for you. Will potential rental incomes be included in DTIs?
Yes, they will. Cool. And in fact, they are not shaded in the debt to income calculations. They use your full rent when assessing it under the DTI.
Gotcha.
So really important to understand, these calculations are quite complex. Your rental income is shaded from a UMI perspective, from a can you afford the mortgage perspective, from a do you have too much debt perspective. They include all of your rent in that.
Someone asked the question, rent versus Airbnb in Queenstown. Now, this might actually be one that we model out and do a podcast on, just to put that on your agenda. The answer, which I hate, is it depends. So if you're going to tick over the $60,000 threshold for GST, remember, of course, you'll pay GST regardless with the app tax, but if you're going to tick over it and then you're going to have to claim GST on the purchase and pay it when you sell, I would say, personally, I would not Airbnb, purely because the turnover, if it was going to mean that I was going to pay essentially capital gains tax without a capital gains tax, I wouldn't be interested in that. However, it's a great way to get up your income, so you have to just weigh up the pros and cons. Airbnb's less consistent income, but rent's more consistent, but you are going to sacrifice the amount that you get. So it depends on your age and stage. If you're retired, you might be quite happy getting the $800 a week coming in from your Queenstown investment because you want it to hit your account every week. If, on the other hand, you're younger and you've got more flex in your personal budget, maybe you want as much money as possible, so then maybe Airbnb is the right option.
And actually, just while we're thinking about Airbnb, talk to us. How do banks assess Airbnb income when you're applying for a mortgage?
Yeah, that's a really tough one. So because it is much more volatile, you can't count your Airbnb income, or it's much more restricted. Is that right?
Well, I'm asking you.
Oh, yeah,
because
yeah.
you're the ex-mortgage broker.
Yeah. Well, the Airbnb wasn't around when I was a mortgage broker, so I don't think they include it at all. If there's a mortgage broker here, they might be able to tell us that. But because it is volatile, the bank might accept a normal rental assessment and say, okay, well, worst case scenario, we'll use that. But I think it's going to seriously impact your UMI. Next question is, hey lads, assuming the average delta of 2.2% between 1 year and home loan interest rate and the OCR, where do you forecast the test rates to go below 7%? Or when do you expect that?
Oh, do you know what, Jay? That's such a good question. I'm kind of the opinion that 7.5% is going to be our terminal rate.
Yeah, okay.
Now, what I mean by that is that I don't see the banks going much lower than 7.5%. Now, it might get down to 7%, but I'll tell you the reason why I don't think that the servicing test rate is going to dramatically fall. Back when interest rates were 2.2% and really, really low during COVID times, the servicing test rate got down to 5.8% at some of the banks. In fact, some of the banks, from memory, one of the smaller banks actually got under 5% for a servicing test rate. Then what we saw was that interest rates climbed up to 7.4%, was the one of the highest one-year rates that we saw. And so we saw that interest rates really got above, for some people, what they were tested at, and that puts them under strain. So I don't think we're going to see much lower than 7.5%. Those banks that are currently still at 7.7% or 7.8%, I do see them coming down. I think they'll come down. I don't think that we'll get under 7%. No. Is kind of what I would say. I don't think we're going to get under that, but that's a really good question, Jade.
But the DTIs are going to take effect anyway.
Well, actually, that is the one caveat that I'm glad you reminded me of. Because we've now got DTIs in there could be an argument to say that they'll come down a little bit more, but I don't think that's going to happen personally. I think we'll be somewhere between 7 to 7.5%. I think 7.5% will kind of be our long term. Bear in mind that the kind of neutral OCR rate is somewhere between 2.75% to 3%. So bang on 2.5%. You're kind of at that 7.25 to 7.5.
Jim asked a good question. Can I use my existing mortgage broker relationship and your advice and developer connections? Absolutely, Jim. So we've got a bunch of services. So we've got the property selection, the financial advice, the mortgages, the insurance, the property management, the accounting. You can pick and choose what services you want to use, and you don't have to use all of them. We'd love to work with you, but it doesn't have to be at the detriment of existing relationships. Someone said, is the sell one, buy two strategy discussed in the book, please?
I think so.
I think so as well.
Let me just go to the index.
But also, everything's on our website as well. So if you jump on our website, someone asked before about flipping properties next year and what should they go back and listen to. Jump on our website. It's got an awesome search function. If you type in your topic, it will come up with everything that we do, webinar, podcast, article, and you can go and look at the things that are relevant. Did you find it?
Yeah.
It'll be there.
I think it is there. Maybe 210. There's quite a lot in that book. Go have a little look.
Someone said, do banks typically calculate personal expenses, or do they how do banks typically calculate your personal expenses? Do they use actuals, or do they base it on averages? So the CCCFA, the Credit Contracts Consumer Finance Act, meant that banks had to be really stringent around looking at how you were spending your money. And that's been in play for the last couple of years. That's been kind of revised at the moment. So banks are less tough on that assessment at the moment. But basically, normally, if you're using a mortgage broker or you go to the bank, you'll outline up what you think your expenses are, and they'll take the higher of the two, what you say and what they say that a normal two adult, 2 kids, 2 cars would cost. And if it's $2,500 that you say, yep, that's what I spend a month, but the servicing test rate says 2.7, they're going to use 2.7.
There was a really, really good question that somebody's asked specifically about some of Adrian Orr's comments. I'm just trying to find a really good graph for you to explain what I'm talking about.
While you do that, I'll answer
go
this
on
one.
then.
How does split banking work if they're using one property to guarantee the other? Now, the reason for split banking is because if you buy a new build investment or any investment, the bank's got a certain amount of money they'll lend against that. Now, if you refinance that, you can fall under what's called the dollar for dollar exemption. So if you move, say you borrowed at when the LVR restrictions were 40% is a good example. You needed a 40% deposit to buy in Auckland for a period of time there. If now you've got more equity because the value's gone up, and your mortgage was 100% because it was cross-secured against your other properties, you can borrow up to 80% of that current property value, even though the restrictions say 70%, if you refinance it. So long as it's moving that mortgage across, talk to a mortgage broker about that.
Yeah, cool. So we're going to talk about property growth rates and some of Adrian Orr's comments. So somebody said, look, Adrian Orr's criticised property investors who jumped in after the COVID times where people saw those really low interest rates and thought, hey, I'm going to jump in. And what he said was that the Reserve Bank will potentially seek new levers to stop that behaviour if it doesn't change. So should we expect that property prices will go up less than what has historically been the case? I think absolutely. That is very, very prudent. In fact, one thing that really gets up my goat a lot, property investment companies who over-egg their assumptions. So let me tell you a little story. Recently, I had Ben, who's one of our financial advisors, come to me and say, Ed, we've got a client who's talking to another property investment company. And this is, I won't name them because it's not about berating anybody in particular.
What's from my ear?
No, I'm not going to do it. I'll tell you after if you take me out for dinner. Who was it? Oh, who said, I'm recommending a property in Christchurch. They were recommending a property in Christchurch. And they said, we think or we forecast that property prices will go up by 7% a year in Hamilton. Sorry.
They're off their head.
In Hamilton, simply because that has been the long-term average. And I said, well, that might have been the long-term growth rate, but the issue is that only certain times have property prices in Hamilton gone up by 7% or more per year. You either had to buy around 2007, 2005, or buy at any time after 2020 for property prices in Hamilton to go up by that amount. So do I think that 7%, even though that has been the long-term growth rate, if we look at what it's been since I think about 1992 right through to 2024, that wouldn't be a prudent assumption for long-term retirement planning. In fact, I would suggest that a 5% growth rate would be much more prudent because the majority of the time, property prices in Hamilton have gone up by 5% or more.
And one thing I'd suggest is use Opus Plus because you can go in there and you can put in your real property you're looking at. You can put in all the costings and you can leave some of the assumptions there like the growth rate and the inflation rate and all those kind of things. And you can get an unbiased result in terms of the numbers because it's not the company advising you on that. Any in-person seminars planned for next year? Missed your last one in Auckland. Would love to come to your next one. I don't know that we have got any in-person seminars, only because they're quite hard for people. We've got to choose the right areas. We are doing a tour next year, right?
We are doing a tour, but it's going to be clients only. So I've got one planned for July, and I want to do a series of client appreciation events. I've got it planned to come to Christchurch, Auckland, and Wellington. And we're going to be talking about some specific features that we have built in and are building into Opus Plus that are going to be just for Opus clients. So I'm really excited about that. And so if you are an Opus client, you're going to be getting an invitation to that next year. And again, as it is for for all of our client appreciation seminars, that's going to be free. So that's going to be really cool.
Richard said one of the other bank criteria that limits lending is the borrower's age. That's where he's discovered it. And being close to retirement age, can you talk about possible options? Does the spreadsheet factor in borrower's age? No, it doesn't, Richard. What I would suggest you do, though, is you talk to a mortgage broker about some of those non-bank lenders who are much more pragmatic when it comes to someone's age, because let's face it, people A, work longer past retirement, but B, if it's a rental property they're buying, they just sell that when they're ready to. So it's not so much about when they're going to generate an income from that as when they're going to cash it in. So banks might do it if you're using a mortgage broker. If you're not already, I'd highly recommend you start doing that. Otherwise, I would look at those non-bank lenders.
So Sheen has asked a really good question that I just want to talk about, which is, will property prices go up in Auckland, specifically in areas where development has been stopped by Watercare? That is a
question.
Great question. And what this is all about, for anybody who's not in Auckland or maybe hasn't seen our video on this, even though it's a really good video, is that Watercare, who manages all of the pipes under the ground. I know what I'm doing.
I love that.
The pipes under the ground that manage our stormwater, our wastewater, and our drinking water. They've said, hey, look, to some developers, I know how you got your resource consent, but we're not going to let you connect your townhouses to the water pipes underneath the city, because they're being used too much already. So we're not going to let you do that. And in fact, in some areas, we're going to say, you've really got to apply to us before we let you use those pipes. And effectively what that means is you are not able to build a property in those specific areas until you get that added consent from Watercare. This is really, really important. And so what that will likely do is limit supply. It will stop developers building as many properties in those areas. Now, it does mean you're still going to see some development there, but there is probably going to be less than there was. So the fact that you've got less supply in those areas, it probably means that you might see more capital growth than you otherwise would have seen. One thing I'm quite excited about, which is a really weird thing to be excited about, is a lot of our clients have actually already invested in those areas. So the fact that supply could be stopped, that is probably really good for certain Opus Partners clients who have invested in those areas.
Okay, Mary Gomez is asking about a cashback on properties that she's seeing, and this is the quote: "Some properties offer a cashback. Example of a property for $573,000 with a, wait for it, $50,000 cashback." How does the bank calculate this? Mary, and anyone listening to the show, if a developer is offering you a $50K cashback, that is a shitty investment. It's being dressed up to make it seem like a good investment, and you're overpaying on it. I'd say more than 50 grand. So the bank is going to take that amount of cashback off the price because it's not real. And I really think you should get some independent advice on that. We've done a whole bunch of content on cashbacks and things that the lipstick that developers put on a pig. And Ed's going to bring up one of the, and hopefully someone can put this in the chat, one of the things that you can do, or the steps you can follow to see whether or not a cashback is dodgy or whether or not it's legitimate. But a 50K cashback, put it this way, Mary, do you think developers have all of a sudden just got generous? No, they're trying to move some of their stock that maybe isn't selling, and the reason the way they're doing that is dressing it up with something that's really not it's disingenuous.
Cool. We've got time for probably 3 more. What else is tickling your fancy, Andrew?
That one
I'll choose.
It got me all hot and bothered.
Okay, I'll find one. So one person has asked, are there any advice for people who are self-employed on how to be more favourable to the bank when your business pays all your expenses and they request you to add in expenses?
Oh, you mean your tax avoidance and now you're struggling?
So what often happens with business owners is your accountants have been doing such a good job of helping you save on tax, and you might be putting certain expenses through your business to make it look like your profit is lower, and because your profit is lower, you then pay less tax. The double-edged sword about that is the banks say, well, hang on, you're not making that much money, and so because of that, we're not going to give you a loan. My advice would always be to go and talk to a mortgage advisor just to have a little bit of a chit chat, because one thing that you might have to do, and some of the tough love we have to give to some of our self-employed clients, is, hey, you've got to put less expenses through your books, through your business, if you want to get that mortgage approved. That may mean paying a little bit of tax, a little bit more tax, but it's in service of that larger goal in order to get that mortgage approved. That's kind of the main one that comes to mind. Any other tips that's coming to your mind?
No, I was reading more comments actually. No.
Well, I've got time for 2 more.
Okay, so I'm going to group 2 together. Jordan said, what's going on with the rental market in Auckland? I can't get a tenant. It's been 4 weeks. And Stefan said, Tony Alexander on the Sharesies podcast said that there's an oversupply of townhouses in Auckland. Is it the case everywhere else in the country? So it is a hard time to rent a property today in Auckland. And that's because there's a lot more stock than there has been previously. There's a lot less demand, and we're entering Christmas. No one is in mover mentality over this time. So, Jordan, it's going to be probably another few more weeks. It takes 80% of people 6 weeks to find a property right now. To tenant right now if they're renting something out. So I think just stay the course. It is tough out there at the moment, and there's not much you can do about the timing of the year. If you've got a property that's settled at this time of year, you kind of just have to weather the storm. Stefan, no, it's not necessarily the case everywhere else. And one thing that's interesting is it can change on a daily basis or a week-to-week basis. We meet with our property management team every Monday, our entire team, and the last 2 weeks, they've had exceptional numbers of properties being rented. Jordan, it doesn't help you out, but it hopefully will in the near future. So I'd just say, just stay the course.
And can I just talk about that specific idea about why is the rental market quiet or a bit more difficult, and is it all down to townhouses? In fact, TradeMe puts out some really interesting data that we get access to because we own a property management company. And if we look at Auckland specifically, we see that the number of searches going on at the moment, year on year, so November year on year, is down 11%. There were still 2 million searches for rental properties in Auckland in November, just last month, but they are down year on year. If we look at total supply is up 19%. But one of the things we can do is we can split it out by property type. So, total supply is up 19%. If we look at houses are up 24%. If we look at apartments, for instance, apartment supply is up 9%. If we look at townhouses, yes, townhouses are up 33%, but if we lump in units too, which are usually lumped together, they're up 18%. So it's not just the fact that, hey, there's an oversupply of townhouses, which is very easy to point out. But when it comes to the rental market, actually houses and apartments and units are all contributing to the fact that there is more rental supply. It is not just that you see a lot of townhouses being built, and therefore that's the one cause of the fact that it's a bit tougher to rent properties at the moment. The data doesn't support that.
Jeff said offer a week free rent. I actually disagree with that, Jeff. I think sometimes that attracts the wrong people. But Joe said try making your property pet friendly. I completely agree with that. I think that makes a huge difference. There are a couple of questions around the DTIs. Someone said, does that apply to new builds? No, it doesn't. So there's a carve out. There's an exemption for new builds. Someone else said, if I split bank, I've still got the debt and banks look at the other debt. Yes, that is correct. Split banking helps you from an equity perspective, an LVR perspective, not from a servicing perspective.
Fantastic. We're going to wrap it up there, but thank you so much to some people like Jade, who is an absolute legend,
Jade,
who was the first person here and the last one to leave at every single webinar. It's so great to have so many of you guys who we see your names every single month here in the community, answering each other's questions, helping each other out. We're going to go take a break. We're going to be back in February with another webinar, and thanks so much for being here, and Merry Christmas. See you guys later. Bye now.